Today is Tuesday, the 14th of April, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Yesterday, I dealt with a fall scale and what that means. So you can check it on my LinkedIn profile or in YouTube that I uploaded a video. But today we are moving to point 2 on the design of the advisory board operating system, which is the growth and capital. And this is very, very important, particularly when you are raising. And I'm going to mention a few things that if you're not aware, that's fine. If you're aware, very good. It's a good refresher. But how it works in the overall process is very important to understand, which is the right sequence of things, etc. So we are not going to go in deep into the process, but I would like to cover why it's important is not only for the large enterprises, but for the small and medium enterprises, which seems that it's squished all the time with taxes and more problems and access to capital, etc. I think that this is very important because actually it's helped to understand how other organizations work and how you can apply the same principles to your organization. Because at the end, is the same thing, is principles. So the mechanics are the same. Knowing the mechanics and how to apply to your own organization is the key here. So I mentioned publicly listed companies, what they do, what are their challenges, but listen what I'm saying, because actually the template, the blueprint is there. So it's much easier to say, oh, now I can now understand, or if I had the idea, now I say, oh, I have an alternative here, how to deploy this and get delivery that I'm looking for. So here's the full model, but today we're going to go specifically on section 2, which is partnership revenue and assets in terms of predictability, growth, and capital. So let's start with today's activity. So from the asset lens, I want to mention that this is all about the capital assets today. So asset, you have many tangible and intangible assets in your organization, but today I would like to talk specifically about capital. And this is backed by cash, followed by discipline, the governance and control, right? So this is the whole circle. And this is where I come in as a board advisor, by the way. I built a rotating international advisory board around the milestones in front of your company. So you get the specialty and the capabilities of the specialists you need in a fraction of the time of hiring one executive, without the big consulting overhead, without the talent locking, and with the option to swap members every 6 months. So as the project evolves, because every company, as they evolve, they need new specialists, new connections, new access to different groups and people to evolve faster than the rest of the world. And this is the beauty of advisory boards. By the way, 50% of the SMEs, and this is a study done by the Bank of Canada, 54% of the SMEs in Canada, and I guess that actually that can translate to everywhere in the world, they are thinking about an advisory board, even if they have a non-executive board, even if they have a very strong executive team, even if the founder have very clear ideas what to do and what to do next. And why they don't put the boards of advisors together? Because it's too difficult, it's too disruptive. They take a lot of time to bring the right talent, but I can help you to do that in a fraction of a time. So let's go to the unpleasant realities now of what we are talking today. A weak capital structure does not usually fail with one dramatic moment. So you say, oh, all of a sudden, boom, everything collapsed. No, it fails quietly, right? So it's things that you don't see, that you don't appreciate, that actually slipping into the next meeting, and at the end never happens until it really happens. And this is a kind of a dramatic fail, if you may. So what happens is that you start to see that your options start to narrow. Yeah, you start to see your negotiation position start to get weaker and weaker and weaker. And also you can start to see that management work for the capital stack instead of making the capital stack work for the business. And when I mention capital stack, let me clarify this, because some people say this is too abstract. No, it's not that abstract. It's very simple. And in the simple terms, the capital stack is you split it in 2 ways. One is the debt, which is debt, could be financing, invoices, etc., which is the lowest risk. And then you have the equity portion, which is the highest risk. And when you're talking about equity, you're giving up control and capacities and votes in your company. In terms of debt, you still have all those control. That's what I'm saying, like high risk, low risk. There is a whole theme around capital stack. I'm not going to get into the full details. I just wanted to mention it because many people say, what is a capital stack? It's just debt underneath, which is the lowest risk, and the top is the highest risk, which is when you're giving equity in terms of financing, investors, etc. Now, let's go into stats. And this is the portion where I see the problems and where the problems are identified by in the UK, and then you can transpolate that to your own organization. But listen to this, because all the principles that are mentioned here are very, very good. So you don't have to go and learn what are the problems. The problems are very evident, and there is enough supporting documentation and surveys, and also potential frameworks and guidance and suggestions what to do with those problems. So then you don't have to reinvent the wheel. It's already there. So you have the identified the problems, and then the frameworks how to solve them, and you transpolate that to your organizations. Now, the first problem is timing, right? People want money fast. Here's a problem. The Bank of England says the economy still does not look like the brightest point now, right? And it's not just the Bank of England. You look around the world and you will see that happening everywhere. So with weak investment intentions, squeezed profit margins, and only modest increases in demand for and supply of credit, meaning that actually they have more money available than actually the money that can deliver to the people that are looking for capital. And this is in that sort of market, the capital does not reward urgency, it rewards readiness, right? So when the banks or the investors or the financial institution, they start to see that they have more capital than actually the companies are ready to acquire this instrument, they look into how ready you are. They are not looking into something urgent, right? Because actually the things are uncertain, the things are not they are blur in front of the future, the next, what's going to happen in the next 3 months, 6 months, 9 months. So what the banks, in this case, the Bank of England is saying, is they are saying how ready you are to handle this, right? So it's not it's not a problem of cash, of the capital. It's a problem how ready you are, right? The second problem is a false comfort, and this is coming from PwC says that London had its strongest year in IPO last year in 2025. With 1.9 billion raised through 11 IPOs. But then look what happened this Q1 2026. EY says that when followed, just 2 IPOs happened in Q1 2026. So if you see what's going on, so boards that wait for the perfect market window usually discover the window is not waiting for them anymore. Right? So if 11 IPOs happened throughout 2025 and only 2 in the Q1 2026, in the whole quarter, right? It's not so we, in 3 months, only 2. So we'll say, well, probably at the beginning of the year, we are right on the track, similar averages for last year. But EY already saying, careful, because actually it is not at the speed that it should be for the whole year in Q1. Anyway, the third problem is structure drift. So again, the British Business Bank says around half of smaller businesses seeks external finance, which is very good, with more use of flexible finance in 2025 to support cash flow, while equity investment declined in 2025. Right, and the same levels of 2019, so pre-pandemic. So, and then we have another stat behind this. The insolvency services shows that 1 in 194 companies entered insolvency in the last 12 months up to February 2026. 2 months ago. So, and the board should be asking this question then: are we funding growth or funding strain, right? So, what is this structure drift means? That in reality, the companies are insolvency doesn't mean that actually they are broke. It means actually they are insolvent. They need liquidity. So it means that actually the companies need to get ready for growth, and as I mentioned earlier, and not funding for the problems that they have right now. You see the difference? That's when we talk about preparedness. And all these stuff, you say, well, this is IPOs, London Stock Exchange, etc. What the hell have to do that with me? Probably have a lot to do with you, because these are the same problems that if you can imagine, if a large organization without all the capacity and resources that they have run into these problems, it is not surprising that you run into similar problems. So why I'm mentioning all these things, because you can start to see again how they solve these problems, and then you say, well, this is the same principle that can apply to my company. So in other words, imagine the capital stack, which is a debt and equity, as a keel in a ship, right? So you don't know what's going on when the waters are calm, right? Because there's no challenge in terms of how the boat is navigated. But in rough waters, you find out whether was designed properly or not. And keep in mind this word, designed, because many people are looking into raising finance against equity too quickly, in my opinion, because this is one of the designs that actually are a challenge in the future. And I'm going to talk about this, what are these challenges in a second. So the question here is, how does your team, your board, or yourself as a funder do when you want runway, valuation, and control all at the same time? So what do you do when you need money to run for another 9 months, when you want to see what is your valuation today, and but you don't want to lose control of your company, right? Now, okay, so as an advisor here, I come and I look into three things. And the first thing is to separate the capital questions into three parts. Number one is debt, the second one is equity, we mentioned that, and third is control, is a question that I pose here, right? So debt changes the debt changes the pressure. The equity changes the ownership, right? But the control changes who gets to shape the next move, right? So in debt, you don't have pressure. In equity, you are not the full owner anymore. But control is very important, because who gets the next, or who shapes the next move of the company. So it might not be you anymore. And this is quite dangerous. That's why I'm saying the risk of the debt and the equity, or the other way around. If you as executive team, as a founder or a non-executive director team talks about funding without splitting those three parts, it is talking to lose, right? So you have to look into debt, equity, and control in your capital stack. The second thing to look out is a scenario test before your fundraise. Ask what happens if revenue drops 20%, right? Ask what happens if the next round splits 6 months rather than the 3 months that you forecasted. Ask what happens if a new investor wants rights that look small today but become strategic later, right? So sometimes these things happen. So it's not that the money is not available. It's not that actually the investor is not willing. The situation is actually they ask for things that you go like, yeah, I can agree that actually today it doesn't look very dangerous, but what will happen in a year time or 2 years time on the next round, right? That is where capital engineering starts. That's what all this is designed. It's not something that you go easily and say, yeah, let's raise funds so we can keep growing. It's a different way of thinking. So the third thing is to make governance visible. So the Financial Council Authority reforms were designed to support UK market competitiveness and capital raising, right? So you have the structure that I mentioned, the guidance, etc., etc. However, the Financial Council Authority is also explicit that the companies still need proper governance and engagement with shareholders, right? So the capital is not only a finance decision, it is a governance decision with the legal and strategic consequences. Now, let's put the last hard question for today. Who helps the board design all of that fast enough to matter without locking the company into one expensive hire or one generic consulting team? And this is where I come in and put together, as I mentioned, the international advisory board, because actually now international is very important. It's not even if you play nationally. So what do you gain working with me? Three things: business outcomes, differentiators, and risk reductions. In terms of business outcomes, I help boards turn capital from a scramble into a system. So funding supports growth instead of distorting it. In terms of differentiators, I build a rotating international advisory board around the exact milestones that your company are looking for. So you get specialist capabilities across finance, investor readiness, governance, strategic, and growth in a fraction of the time of hiring one executive, and without the overhead of a large consultancy. In terms of risk reductions, members can be changed every 6 months as the project evolves, because actually once you have the money, the capital, you have the expert to do that. What is happening next? Well, they are specialists in raising capital. What happened next? They are not specialists in governance or operation or scaling or innovation or transformation. So these members can be replaced by new members that actually have the expertise of the next stage. So you keep the right expertise for the stage you are in, rather than carrying the wrong structure, the wrong cost, or the wrong bias for too long. Right, okay. One action you can take today, and it's doable in 30 minutes or less. Before your next board or your executive meeting, or yourself as a founder with your team, ask the team for a one-page capital map showing every funding instrument, every key convenient or shareholder right, every refinancing date, and the one decision each instrument could constrain your organization or yourself, right? So let's pause it here for today and reconvene tomorrow, because tomorrow I'll go further into what is next, which is controls and resilience, because capital only stays useful when the systems underneath the company can absorb shocks without breaking. Have a great